Okay, thank you ever so much, everybody. Everybody knows that I'm a firm believer that you should understand what's happening in your business area, what costs are changing. And today was the opportunity ahead of the 6th of April to talk to you about the increases in national insurance and dividends that are due to come into force from the 6th of April 2022, being the start of the new tax year. This is to help fund the NHS, including the impact of the pandemic, and it's looking to close the gap in the social care costs. So today we're going to start by having a look at national insurance. Okay, so the national insurance threshold and rate changes are set to rise by 1.25 percentage points from the 6th of April 2022. This will be taken, even though it's going to be considered as a levy, alongside your national insurance payment in the 2022-2023 tax year, but it will be officially split out as a separate levy, but that will not be until April 2023. From April 2023, as we're all getting a little bit older, I also need to point out that the levy will be paid by those of a state pension age that still continue to work as well. So national insurance contributions are not payable by state pensioners. That will continue to be the case. But from April 2023, the levy of 1.25 percentage points will apply. So if we can move on the slides just a little bit, please, Shamshad. Okay. Shamshad?
Yeah.
Can we just move on the slides? Okay, thank you.
Can you see them? Yeah.
That's the employer contribution. Have we got an employee contribution just before that? Sorry. Okay, thank you. I just needed the table. Okay, so in terms of class 1 national insurance contributions, this is payable by the employee. So as speaking here today, as directors, our employees, and quite often we're on the payroll system as well. If we're affected by a contract that is inside IR35, then national insurance contributions are obviously quite a large factor in the payment that you receive as well. So what I've just done here on the slide is highlighted to you at different salary levels what you're currently paying in national insurance, and with the increase of 1.25%, what that will look like from April 2022. So this will impact upon your employees, and it will also impact upon yourself if you're working with inside an IR35 contract. So some employees may have some questions for you with regards to their payslip from April. If you do have any queries, then you can ask us, but there will be this additional 1.25% levy. So we also need to consider, as employers, either of ourselves or others, the class 1 employers contribution. So this also will increase by 1.25% from April, and this will also be applied to class 1A national insurance contributions. So class 1A national insurance contributions is the national insurance that we pay on any benefits in kind that we either receive as ourselves as an employee or that we provide to employees. So this will be anything like medical insurance or company cars. So when you look at that slide, what you can see is that the national insurance rate will be 15.05%. So when we're thinking about our budgeting, our cash flow, and our pricing of future contracts or any works, then we need to consider that where the salary level is over £9,100, there will be this additional cost being the employer of employees. The changes to national insurance will also affect the self-employed. So self-employed individuals pay class 2 and class 4 national insurance. So the rate that we pay through our self-assessment tax return for class 2 national insurance will rise to £3.15 per week from £3.05. But you will see that the class 4 national insurance contributions, which are payable as a percentage of your profits greater than the lower earnings limit, will also increase by this 1.25 percentage points. So that's taking the rate of Class 4 national insurance contributions to 10.25% from 9%. And you can see on the slide there that the lower earnings limit banding does increase just slightly. That starts to look at national insurance. So most of us on this call today take the majority of our earnings through dividends. So dividend tax is also subject to change from the 6th of April. And just like the national insurance rate rises, then the dividend tax bands, the rates will increase by 1.25%. There will still be a nil rate band going into the new fiscal year of £2,000. So the first £2,000 of dividends are free of tax. And then if we move on to look at the table, then we can see what the current rates are for the different tax bands and what the rates will be from April 2022. So for the after our first £2,000, currently we go into the basic rate tax banding, and that's 7.5% currently. Any dividends that are declared from the 6th of April, the rate increases to 8.75%. Once we pass into a higher rate taxpayer, rather than paying 32.5%, we'll be paying 33.75%. And then if we fall into the additional rate of tax, that again increases by the 1.25 percentage points. And remember, dividend tax doesn't apply to any dividends that we receive on stocks and shares ISAs. So any stocks and shares that we've got within an ISA wrapper are not subject to dividend tax. So that's thinking more about your investment income than the monies that we take from the limited company. So what do we need to think about now before the end of the fiscal year? So firstly, looking at dividends, well, should we be taking more money from our company as dividends before the 6th of April, so that we don't have to pay so much on the 1.2 with a 1.25% enhancement? So my personal opinion is that the basic rate banding goes all the way up to £52,270. So we should be taking dividends potentially this year, if profits allow, if cash flow allows, of £39,700 at least, because that will be coming out of the company at 7.5% on your personal tax return, rather than having the additional 1.25%. But remember, the sooner we take our dividends, the earlier we pay our personal tax. So we are bringing forward any additional tax payments by 12 months through the self-assessment system. If you tend to take bonuses from the company, then maybe we should be looking to defer any bonuses instead. And the reason for this, and the reason we potentially need to do some tax planning in this area, if we pay bonuses to staff or if we take bonuses ourselves, is that we will be seeing an increase to the corporation tax rate from 19% to 25%, as we've previously communicated. So we do have the opportunity potentially to defer some of the monies that we take from the company, to take it as a bonus instead, and to reduce the profits for corporation tax purposes. Please remember to use your £2,000 band, and that's nil rate before the 6th of April if we've got profits that allow for that. And if you've got personal investments, then remember to make sure that you're taking advice on using your annual ISA allowance there as well. These give us lots of opportunities. We have done the maths. And it is still the most tax beneficial position to be taking a low salary, high dividend approach for the shareholder that's the director of their own company. So as I say, many of you on the call today, and just watch in your salary from April, there will be a movement up in the lower earnings limit, as we've noted. So our salaries will be, instead of £797 gross, they will be increasing that to £823 per month gross. And we'll remind you of that when we send the payroll reporting pack out as well. Just turning to have a look at tax planning for national insurance purposes. Predominantly because of how we pay you, looking at employees. But just some things to think about to start saving them some national insurance, and you as the employer national insurance as well. So one of the things that we can do is look to do a salary sacrifice scheme if they're looking to put more money into a pension. So this will generate savings for both yourself from an employer's national insurance point of view, and also save the employee national insurance contributions as well. So that's potentially something to be discussing with employees. We can also look to implement a salary sacrifice scheme for arrangements relating to electric cars. So thinking about your policies and facilitating the retention and recruitment of employees, then, as I say, maybe implementing some kind of salary sacrifice scheme for benefits such as electric vehicles. We also need to remember that the employee or yourself does pay national insurance contributions on the value of their benefits in kind as well. So maybe we should be looking and being responsible as the employer to make sure that we're getting the best deal on our private medical dental insurer, as an example, to ensure that the costs to the company are as low as possible, reducing the Class 1A NIC, but also reducing the employee's expense there as well. We can make sure that we make wider use of any benefits that are exempt from NIC to reward our employees as well. So making sure that as the employer, we look maybe to do things like providing them with eye tests, thinking about workplace parking, because those things are exempt from national insurance. And we also need to make sure that we're using trivial benefits to potentially reward staff. So remember that the trivial benefit is where we're looking to give an employee something that's £50 or less, isn't a cash card. It's not rewarded to their performance. So maybe it's their birthday, it's Christmas. And remember that trivial benefits can't be contractual either. And always remember, as a director, that HMRC have stated that trivial benefits can be provided to directors. So we can buy ourselves a birthday present from the company, a Christmas present, but they have now stipulated in case law that they're looking to limit that to £300 per annum. That's still 6 nice gifts for ourselves for various celebrations throughout the year. So there's a little bit of a whistle-stop tour of the changes that are applying to national insurance and dividends, and some food for thought potentially in terms of any tax planning as well. So we'll open the floor up to any questions.